I'm Sev Meneshian, Certified Financial Planner with Pro Exam Tutors. Today, we're going to talk about restricted stock in the 83B election. So if you like this video, make sure you like it. Make sure you subscribe to the channel here because I will be uploading more videos over time in an effort to help you pass the CFP exam. Okay, so let's talk about our restricted stock and the 83B election. And let's look at how maybe the board is going to come at you guys with these separate but related topics. All right, first, a couple of notes here on the restricted stock. Well, what is it? This is not a form of cash compensation. It's not like a cash bonus or anything like that. It's equity compensation. And the employer, in essence, says, look, if you are around at our company and you complete 5 years of service, we're going to grant you this stock. All right. Or, we're going to say you're the new sales manager, and if you increase sales by, I don't know, double the sales in the next 5 years or something, then we'll lift the restriction on this restricted stock. Okay. All right. So taxation or tax-wise, what is the board possibly going to ask you about? Well, if a new employee comes along, maybe it's a sales manager, as I mentioned, and they're granted these stocks, but there's a restriction on there. We know that there's actually a substantial risk of forfeiture. So employee, Mr. or Miss Employee, you're not going to be taxed at this point. And employer, by the way, you're not going to get a tax deduction. Okay, we have an offsetting tax system. So really nothing happens on one end or to one party unless something on the other end happens. Okay, keep in mind that the restricted stock is different than your phantom stock. And we can actually be granted, those stocks can be granted at a discounted price as well. And again, until that restriction is lifted, we don't have control over that stock. Okay. So looking into the 83B election, what's the 83B election all about? Well, it's saying that IRS is essentially saying, look, yeah, you're not going to be taxed on this stuff when when that restricted stock is, let's say, announced or when it's granted to you, because there's still a substantial risk of forfeiture. There's no economic benefit. There's no constructive receipt. Remember those 3 tax doctrines that you have to be well versed in. So make sure you go back to those 3 income tax doctrines: substantial risk of forfeiture, and then your economic benefit and constructive receipt. But IRS basically says, hey, if you make a 83B election, you can make the choice of actually being taxed at ordinary income tax rates now on the value of that grant. Okay. And then in the future, when you go to sell it, everything that happens from today, let's say your first day of work, and all of that growth, that will be taxed at capital gains rates. Okay, so this is what's happening right here. The employee alerts the IRS that he's claiming ownership of the stock prior to it actually vesting, prior to the employee actually taking legal ownership of those shares. From a time horizon, once those restricted stocks are granted, you've got 30 days to actually let the IRS know that you want to make an 83B election and that you will be paying taxes on the value of that grant. Now, when is this a good idea? Well, if I think that this company's got a future and the stock price is at 10 and it's going to go to 200 or something, I do not want to pay income tax on that entire value of the grant and income tax on that growth. I'd rather pay lower capital gains rates in most cases on that growth. All right. So we're going to pay ordinary income tax on the value of the stock at the grant, capital gains on the growth. Okay. And this strategy, obviously, it can backfire. What if you're not with the company for 3, 4, 5 years, whatever the length of the restriction is? Or what if the restriction is, hey, we'll lift the restriction if you double sales in the next 2 or 3 years. What if that doesn't happen? Unfortunately, what you've done is paid income tax on the value of the grant, and maybe the shares have gone down. Maybe you've left the company, maybe you've been fired or let go, and you paid income tax on the value of that grant, and you've got nothing to show for it. There's no income tax deduction for that loss, nothing. So this is a decision that won't be made lightly, and obviously your job is to help your clients through that. All right, let's look at an example with our restricted stock. So we'll look at how restricted stock works, and then we'll look at what the tax ramifications are of just doing this without the 83B election. Then we'll look at the 83B election, and let's see how much money that we've saved here. So Ray is an executive at Aris Incorporated, and he's in the 35% tax bracket. Always, by the way, on the exam, pay close attention to the tax bracket. They're probably telling you that tax bracket for some reason. And one of the reasons we'll actually see in this example. So Ray's employer over at Aris Incorporated grants him 1,000 shares of restricted stock. They're worth $10 a share at the time of the grant. He pays nothing for the grant, right? Substantial risk of forfeiture. There's no economic benefit that this guy is getting. There's nothing to tax him on, and there's nothing to give the employer a tax deduction for. But the terms of the grant say Ray has to stick around for 5 years to take ownership. And as soon as he fulfills that, length of service obligation, restrictions are lifted, Ray is going to get taxed. The employer is going to get the income tax deduction. And we're dealing with a form of non-qualified deferred compensation here. Okay, with non-qualified, we don't really have to play by the ERISA rules. So what happens is that when the restriction is lifted, the company stock is at $30 per share. It was granted to him at 10. So Ray is going to report $30,000 of W-2 income, and in the 35%, and I just used simple figures for the taxes here, he's going to pay 35% of that. That means he's going to pay $10,500 in ordinary income taxes. And now we have an adjusted basis in the shares at $30 a share, right? Because you're paying tax on $30 per share, times the number of shares, 1,000 shares here, and that now $30 becomes your basis. Now, more than a year goes by, Ray is doing a great job at this company, and because of his efforts, the company stock, partly because of his efforts, goes from 30 up to 50, and he's going to sell all of his shares. Remember, his basis is 30. Now that stock price is at 50, and he's going to pay long-term capital gains on $20 per share, the difference between what he's selling it at 50 and what his adjusted basis became at $30. And what does that look like? Well, we're going to have 20,000 of long-term capital gains. We're going to multiply that by 20% and the additional Medicare tax of 3.8%. And so for a total of 23.8%. Just as a reminder, make sure that you're up to speed on the additional Medicare tax of 3.8% and when that actually kicks in. It doesn't kick in for all taxpayers. Okay, so if you crunch the numbers, the total tax that he pays is a little over $15,000, $15,260. That was our ordinary income tax on the $30,000. Once that restriction was lifted and there was no more substantial risk of forfeiture, the employee got hit with an income tax bill, and the employer actually got an income tax deduction because of our offsetting tax system. Okay, so he's got $10,005 of ordinary income tax plus $4,760 as long-term capital gains. So let's cue in on this number, the $15,260. Now, Ray, luckily, comes to you within this 30-day window of when the grant of the stock was awarded. And he asks you, okay, I've heard about this 83B election. I know I have to do this within 30 days of receiving the grant. What should I do? Should I pay the income tax now and roll the dice and potentially pay a lot less capital gains later, or not? Should I just wait till the restriction is lifted? And you crunch the numbers for your client or prospective client here. And let's look at what happened. Alternatively, if Ray makes an 83B election within 30 days of the grant, I've mentioned that now 3 times, which probably means that it could be important for the exam. He's going to immediately report W2 comp on that 10 grand, right? That stock was granted to him when it was at $10 a share. And he's just going to pay $3,500 of ordinary income tax. His adjusted basis now becomes $10 a share because that's the amount of the share that he paid taxes on. And so, some years go by, Ray's around for, more than 5 years. The restriction is lifted. We've got the no more substantial risk of forfeiture. Although in this case, that's not going to matter because he's choosing to pay the income tax up front. But Ray goes and sells his 1,000 shares for a total of 50 grand when the stock price obviously is at $50. And if you'll notice now what we don't have a capital gain of 20,000. We now have a capital gain of $40,000, right? So $50,000 fair market value. That's what he's selling the shares at, minus the $10,000 in basis that was established when he made the 83B election. And he's going to pay capital gains tax at a rate of 23.8% for a total of 9,520. And so let's add up, combined with his income tax and his capital gains. When he didn't make the 83B election, the total tax paid was $15,260. Okay, with the 83B election, the total taxes paid is more than $2,000 less. Okay, so our total tax savings by you, the CFP professional or aspiring CFP professional, is $2,240. All right. So as far as the exam with a restricted stock in the 83B election, this should help you quite a bit in your understanding. If you do have any questions or comments about this video or any other CFP exam related topics, drop me a note here. Leave a comment in the comment section. If you like the video, make sure you like it. If you subscribe, or if you want to subscribe, make sure to do that as I upload more videos on topics that are relative to the CFP board exam. Thanks for watching, and we'll see you at the next video. Take care.